It's been a disappointing year for Indian equity markets.
Absolutely. The broader market's taking a beating, both the mid-cap index, the small-cap index, all of them down over 1.5%.
Where do we go from here and what does 2026 look like? We have Kalpen Parekh of DSP Mutual Fund here with us. So how does one manage their fear in a market like this?
One biggest learning I have had after the first 10 years of doing bad investing myself is to kill the senses which receive these stories. Is to just say that what is my job? My job is to collect units every month because my salary is coming every month. Every month if I invest, if markets fall, my NAVs will fall. I'll get more units. So in 2008 is when I realized that you should celebrate falling markets, not celebrate rising markets.
So tell me, if someone is an investor in this market for the long term, what are the mistakes that one should avoid making?
I'll not chase something which is hot today. What has become very popular generally will not be profitable because what has become very popular gets overpriced. So the biggest mistake to avoid is to not chase blindly only because last 1 year return is very high. Every asset class which earns higher return also in phases will take away those returns. Don't buy narratives and stories, which is nice to hear. What is nice to hear, what is interesting to hear becomes the narrative, becomes part of all WhatsApp group messages every day.
You folks have an offshore fund from Gift City now. Tell me a little bit more about it. Like, why should I invest in international funds?
So there are many business models which are today not available in India. These are business models where life may shut down without them. They have created that type of presence in day-to-day lives by building or by designing business models which are very difficult to replicate. So sometimes you get great businesses at reasonably cheap valuations.
Any major regrets that you have in your investment journey or in your life journey overall?
The only regret is...
Hey guys, I'm happy to be a part of Zerodha's media network. Together, Zerodha and I plan to bring to you simple yet effective and impactful news and views from the best minds in the financial world.
Hey guys, welcome to the Money Mindset. Now, the market is not in the best place at the moment. In fact, it's been a disappointing year for Indian equity markets. We've underperformed most of our global peers. We've been flat year to date on a dollar basis, while the emerging market index is up about 20-25%. So where do we go from here and what does 2026 look like? We have Kalpen Parekh of DSP Mutual Fund here with us. So Kalpen, thank you so much for being on the Money Mindset. This has been a tricky year for the market. A lot of people talk about how India has had nothing to offer this year, and from a global standpoint, that was the argument. But do you think things will change in 2026?
Just rewind 1 year back. If you remember the narratives and the conversations everyone was having was that, the world is not a place to invest and we should only be in India and all growth is here. And FIs are idiots that they are losing out the best growth market of the world, is how narratives were. Today, the narratives have changed within 12 months. Just, one rotation of Earth around the sun and everything has changed. And that, I think, is the more important point for investors to learn or realize, that whatever we say is contextual today, but the investors' goals are for next 5, 10, 15, 20 years. And today's narrative many times make us take wrong decisions. So my belief always, or my experience always has been that whatever is the current topical mood, we should not extrapolate that. This too shall pass has always worked best in life and in investing. So I think rightly, as you said, last year India didn't do well, other markets did well, but the other markets were underperforming for 10 years or 15 years. And India had a very strong performance from 2020 to 24. 4 years of very robust performance, almost 120% up. Nifty, small and mid caps are up 200 to 300% in these 4 years. So one important thing for us to educate our listeners is markets have no guarantee that they have to deliver every year or they have to go up every month. The nature of markets is to fluctuate. The nature of nature is to fluctuate, right? Nature also has cycles. Why is it going to be any different in markets? And all of us who've been around for 20, 30 years have seen ups and downs. If you just take simple statistics for Nifty, 30% of times it goes down. roughly 25% of times. 25-30% of times it is sideways for many years. And then 40% of times it goes up. And generally in those 40% times when it goes up, the quantum is large enough for creating an overall compounding of 13-14% over a long period of time. So I think that's a big game. In between, there will be periods of phases like this. Can you forecast these phases? Probably no. Can you preempt some part of this by understanding the setups? Maybe yes. So exactly in the last 2-3 years, the setup has been reasonably higher valuations, and it's not just the P number of 23-24. For the type of growth rate corporate India has of around 14% over long periods and around 16% return on equity, this combination should earn, let's say, 17 to 18 times P multiple. We've been above that for reasonably moderate periods of time. An investor should know that in such periods, if I invest, I will earn moderate returns. And moderate returns are not bad when inflation is just 4%. So even if you earn 8 to 10% in this setup is not a bad return, is the first thing I would like to say. Second, gold, silver did very well. Japan did well. Europe did well. US continues to do well. And rather than lamenting and worrying, investors have choices today to blend portfolios across these asset classes sensibly and take advantage of them. So I think we need to be dispassionate and very rational investors, and just ask this question: that one, what should be my time horizon? Around that time horizon, what should be my portfolio in terms of the mix of portfolio? And depending on which asset class is relatively fairly valued or undervalued, allocate more there. What is very expensively valued, whatever may be the narrative, however strong may be the storytelling by any expert, don't get carried away. Today, people are getting carried away with gold and silver. Every second or third comment is on gold or silver. Every third fund launch is on gold and silver. 3 years back, everyone said, don't touch gold. But gold and silver is up some 250% since lows. I was just seeing silver over 25 years now. Gold and silver over 25 years have beaten equity markets. Now, the takeaway hence is not that they are more attractive. The takeaway is they have run up a lot more than what they deserve. And core equity is the main asset class, which is cash flow generating, which has growth in it. So when that core asset class starts underperforming, we should not feel disappointed with it. This is a time to keep faith in it.
So I remember a couple of years ago where you started getting bullish on gold and
Yes.
silver, and you've been propagating investing into gold funds, silver funds, etc. Now, what is your view on how to approach 2026? What should the best asset allocation be for a young investor?
I'll tell you what I am doing, and again, it's very contextual. So in my son's portfolio, he's studying his engineering. I give 5,000 rupees to him in his account, so he doesn't have this feeling that money is easily available. It is going into an SIP of a 100% equity fund. His asset allocation is 100% equity, and that fund is a mix of Indian and global stocks. My father's portfolio is 50-50. 50 is in stocks and 50 is in bonds and other things. Personally, my portfolio is a 70-30 portfolio. 70% is in Indian and global stocks, and 30% is in bonds and precious metals. So it's nuance to each person's time horizons, risk appetite, level of understanding. But the way I think about it is that long-term compounding happens from equity generally. So equity should be a dominant part of our portfolios. It is a growth asset. And more than just equity as an asset class or any index, if we narrow down to say that, okay, through a mutual fund or through your own ability to choose stocks, as I broadly assume most people can't do that. So come to a mutual fund. But if you choose good companies at reasonable prices and give 10-15 years to them, you'll see significant compounding. You and I both have seen it in the last 20 to 30 years. So why should we believe the next 10-20 years will be any different? And periods like this, periods like 2025, when the train of compounding has paused on the station, is a time for us to get in. Most people tend to get out. Of course, every time a train comes on a station, people do get out, and many people will get out when markets shake or fluctuate. That is a time for long-term investors to again come and get a window seat.
So, I was reading this report today only that came out from Akash Prakash of Amansa, where he said that FIs have just not been interested in India for the last few years. Also because not just the valuations, but also because India has lost out on the AI trade. Growth has not been reasonable given the kind of valuations we are at. How high is the possibility that this this kind of disappointment from FIs continues for a couple of years. And then what happens?
I think reasonably high, because for enough number of years, they have continued to be with us. FI has been investing since 93. It's been 32 years that FIs have been investing in India, and India was never an AI trade. Even 1 year back, it was not an AI trade. So I am surprised why people are suddenly, just because the world is chasing AI today. So the story of India was always about domestic consumption. That, while in the rest of the world, you have tech stocks as dominant market cap growth companies, India is in a way domestic. It doesn't have the vagaries of global cycle. So India, the largest weight always has been banks and financial services, 30-35%. Tech has always been a 10 to 15% component. So to that extent, just because the stock prices are right now muted, we will always seek for reasons. Having said that, the larger point is more important, that for the last 3-4 years, we had benefited from revenue growth and margin expansion after COVID. That can't last forever. Margins cannot keep rising forever, because our business models don't have that type of either competitive advantages or moats to maintain pricing power or increase pricing. So our margins even today are at all-time high, but revenue growth has come to single digit, and hence profit growth has come to single digit. So single digit profit growth market for a year or two at 23, 24 times is expensive. So whether FI has come or not, this is an expensive market. Investors must be conscious about it, and which is why they should invest using asset allocation funds, hybrid funds, or SIPs. If you have very long-term time horizons, then today's valuation will not matter. 10 years out, 20 years out, it won't matter whether you invested at 24p or 22p. It may have some 1% sort of impact on long-term returns. But clearly, yes, mathematically, valuations are higher than what we deserve, and hence portfolio should be conservative.
A lot of people, Kalpen, believe that to make money in these markets, you need to know maths, you need to know, companies, you need to know balance sheets. Of course, all of that you need to know. But I think a large part of it is also how you manage your own emotions. And this is a time when fear is at a high level, right? Because there's so many negative factors, whether it's global, whether it's the job situation, uncertainty with respect to AI, cost of living has gone up. So how does one manage their fear in a market like this?
I think it's the most important thing over and above a few things that you mentioned. And, let's say we have 60 lakh investors in our funds. The industry has 3-4 crore investors. Not all of them are experts who read balance sheets or understand maths. But what they bring to the table, a lot of them, not all of them, a lot of them bring to the table is the long-term faith that if history has shown in the last 50 years that good companies have created immense value, they have helped consumers around the world to beat inflation and build purchasing power, whether you see American stock market, whether you see most other stock markets of where good companies have resided. And likewise for India, it's important to look at that picture for maintaining faith. Without faith, being in markets is not going to be easy. Without faith, these are exactly the moments when you should not worry, is when we will worry and get out of the market. I'll give you another very startling and very interesting statistic. The oldest fund of DSP has a 28-year track record. In these 28 years, it has earned 19% CAGR. So more than 100x is the value it has created.
Which is that? Which fund is it?
It's DSP Flexi Cap Fund. It was the first fund we launched. And in this 28-year period, almost 6 lakh people have invested, stayed invested, moved out. The number of people who have participated in this entire 28-year journey from day one till today is less than 20 now. Less than 20. So the point I'm making is every 3-4 years, the average holding period of the fund industry itself is 3.5 years. So every 3 years, people get out. Because when they...
But why do they do that?
Because I think when we bring them in with a lot about talking about the here and now. आज क्या होगा, कल क्या होगा, आज अच्छा है, कल खराब है. And mostly money comes in euphoria. Mostly money comes hearing great stories. I think one biggest learning I have had after the first 10 years of doing bad investing myself is to kill the senses which receive these stories. Is to just say that, what is my job? My job is to collect units every month because my salary is coming every month. I don't have an inheritance of large chunks of money. So I'm a salaried employee. So I have no choice but to invest monthly. And every month if I invest, if markets fall, my NAVs will fall. I'll get more units. So in 2008 is when I realized that you should celebrate falling markets, not celebrate rising markets. For someone who wants to still be an investor, if you are going to put money in, You want lower prices. For my father, if he has to take money out, he needs higher prices. So for most of us today who are listening, most of us are still going to be consumers of investing, right? We're going to build our portfolios. So I think we need to train our investors to not worry about volatility and tell them that this is part of the game.
But what about when you hear news reports like, promoters are
Selling out.
selling out in an
Great.
IPO, there is manipulation, there is a front running of stocks, it's just the
True.
promoters and VCs that are making money and retail is left holding the bag. So when you hear
True.
stories like this, then you lose
Absolutely.
faith in mutual
So
funds.
you need to again look at data that this has happened over 20, 30 years, enough number of times, enough scams have happened. Our markets have become far more robust over the last 20 years. Our regulators have done an amazing job. Transparency is at all-time high. Today, you can question fund managers on social media. You can, have them come and talk to you. 10 years back, who had the access to even understand these things? So things have improved a lot. You have to look at the silver lining as well. But more importantly, you're right that when it is our hard-earned money and you see it down 10, 20, 30%, it's not easy. But first of all, markets are still at an all-time high today. So those who are having portfolios which are down 20, 30% have to introspect that what did they buy in the first place, which at an all-time high market level, the portfolios are down.
But even if you had invested in, say, a small cap fund, the fund
Down
is also
5%.
underperforming.
Down 5%. And see, over a long period of time, small cap funds earn 2 to 3% more than a basic large cap fund. That's what historical data shows. A well-managed small cap fund. And I come from an industry where forget just DSP. There are enough peers who I respect who have done a great job in managing small cap funds, where governance checks are there. A lot of accounting filters are in place to ensure you don't get bad companies in the portfolio. But inherently, small caps will be volatile. Our small cap fund again, which has which was at some point rated as the best fund of the world. Some global news magazine gave that award. 2 years later, it fell 50%. Now, it didn't mean that it was a bad fund, but the nature of small caps is volatile. The index was down 67%. So that's the nature of the beast. So point I'm saying is that 2 years back, jumping into small caps blindly was a mistake. Today, doubting equity because of that is also another mistake. What I'm again and again repeating is that the nature of market is to fluctuate, and from very high levels, when markets give very high returns, generally in the next 2, 3 years, either they'll fall or they go sideways, or they'll fall and recover and go sideways for a period. 2008 to 13 markets gave zero returns. But an SIP investor in those 5 years earned 8% return per annum because he averaged all the way down, and then he got, so all the way down, he acquired more units. And when the NAVs moved up on higher units, the NAV. So here the maths we need to know is only one. NAV into units is our formula. So my job is to acquire units. The market job over a period of time is to grow the NAV. But the NAVs may grow, but if you don't have units, what is the point of that growth? And most investors, behaviorally, the bigger mistake they make is they invest when NAVs have already risen. So when they've already risen, you are buying lower units because you're buying at high NAV. And in the next 2-3 years, generally NAVs go sideways after rising sharply. So if you can keep this formula in mind, that my wealth is equal to NAV into units, and if I have a 10-year horizon, periods when markets fall are great opportunity to increase units. And in the next round, NAVs will rise. If you just plot the 10-year history, 20-year history, take 10-year rolling return of any small cap fund, you will never be disappointed. It has earned 2 times to 3 times more than inflation. It has earned 2 to 2.5 times more than what a bond would have earned. So time horizon is very important. But if we expect markets to earn every year or two, I think it's a wrong expectation. And that expectation will always be disappointed.
So tell me, if someone is an investor in this market for the long term, what are the mistakes that one should avoid making? 4 or 5 things that you would completely avoid doing in this market.
So one, I'll not chase something which is hot today. So something which is done extremely well today. See, there is always this tendency. Like, let's go 1 year back. 1 year back, the narrative was capex cycle, manufacturing, infrastructure funds, engineering funds, defense funds, small cap funds, thematic funds. Today, we are just saying that they are bad. So what do we learn from this? That what has become very popular generally will not be profitable. Because what has become very popular gets overpriced. I always keep this in mind, and I have tweeted this last night also, that I look at long-term median rolling returns, slightly complex. And these are the type of maths things that we should learn. That if the median return of, let's say, silver is 8% over 20 years, but last 1 year is 94%, which return will attract you? most of us will say 94 is great, and hence let me invest in silver today because now it has given 94. But it has given. Given means it's gone. Someone who invested 1 year back earned that, not you who's going to come today. So the biggest mistake to avoid is to not chase blindly only because last 1 year return is very high. So today, for example, there are obviously a lot of on-ground trends about demand for silver rising, supply slowing down, industrial demand rising because of EVs, central banks also starting to invest in their investing book, not in their long-term book. Now, this can all unwind. And it can fall 20-30%. Silver for 10 years has given zero return. I'm aware of that. Yet, there could be small probability that it still continues to rise. So what would I do? Will I go and put a lot of new money there? No, but I'll invest in a multi-asset fund, which between 5 to 10% can invest in silver. Today, it has around 3%. It was 5% few days back. It has brought it down. So that's one way in which I could invest. Or I'll size it. I'll say, okay, in my 100 rupee portfolio, let me go up to 3-4%, but not go overboard because just 1 year return is high. So the takeaway is don't chase what is very hot. Last year, people who chased small cap and mid cap stocks first, not even funds, without understanding the fundamentals of those companies, without asking questions, ki iska ROE kya hai, iska governance kaisa hai, and a lot of those stocks are down 30-40%. So I think investors make such mistakes because they don't do the homework right. They don't see the boundary conditions. See, every asset class which earns higher return also in phases will take away those returns. So don't chase hot themes, hot funds. Don't chase last 1 year returns. Don't buy narratives and stories. Stories and narratives are all everything which is English, which is nice to hear. What is nice to hear, what is interesting to hear becomes the narrative, becomes a talking point, becomes part of all WhatsApp group messages every day.
Like, can you give me an example?
I'll give you an example. Last year, there was this narrative that China mein paisa nahi banega because it's a prison. US mein paisa nahi banega because it's a decaying, slowing economy. Japan mein paisa nahi banega. Europe has gone nowhere. And only country where money will be made is India. We've heard this enough number of times. And we have, chest thumped around it so much. But the question, and some of these are all truths. It is not a lie that China is not a democracy. It is not a lie that US is growing slower than India. It is not a lie that Europe for 10 years has seen significant decay in its economic health. All of them are true. India is the second or the fastest growing economy is also true. But at what price are you buying it? So if you buy all the good news of India at 25-30p valuations and ignore all the bad news of the world at 10p, there are chances that you will miss out on the opportunities. So valuations play a very important role.
But since you're talking about chest thumping, don't you think we're doing a little bit of extra chest thumping about India as well for the long term?
That's what I'm saying. Yeah. I'm saying that we should not chest thump. A rational investor's job is to quietly earn money, save money, deploy money, and not talk about it. We have learned from our traditions that पैसा दिखाना नहीं चाहिए. तो पैसा बनने वाला ये भी दिखाना जरूरी क्यों है? It's okay. So I like people who do things rationally, quietly, subtly, softly, and not whichever way beyond extremes. So a sensible investor would say that when some of the best American companies have 20-30% return on capital, which is 2 times of corporate India, and are at the same valuation as India, and growing more or less at similar rates, and have such competitive advantages that they can get profit pools of the world. Without them, we don't start our day. If you open our mobile and see the screen time, the 6 apps you see will all be these global names. So while there is always this hype that they have run up and hence there is a bubble there, but some of it is deserving also. So have some exposure there. There are very dominant companies which are providing battery to the whole world. One is from China, for example. If that is available at 11 and 12p because of, political narrative around China, to the investor, how do I care what is the political? I can size that in my portfolio, 1% in my portfolio. As a fund manager, we do some of these things. Or there are periods when some European companies like Louis Vuitton, which some of them are part of our portfolios, they are down 60%. Because they had become too expensive. They had become a part of rosy chest-thumping narratives 5 years back. Now they have normalized. So they are growing at 7-8% like many companies here in India. But their ROEs are good. And their long-term growth rates, even if they are 6-8%, but at 11p, you will not go wrong there. So I think discerning and blending these things is very important. So what I'm saying is that India has inherent long-term growth because it's the second, fastest growing economy, maybe first now compared to China also. It has capitalism. The entrepreneurs in India respect capital. Our ROCs are the second highest in the world. US is at 18% because of the top 7-8 names printing. Like, I think Apple itself will be in excess of 75-80% ROE. Because, everything, whatever they've deployed in capital, they don't need to do more. Everything goes to back to profit. So there are dominant companies like this there. India has 15%, 16% ROE, which is higher than many parts of the world. So any country where the soil is fertile for companies to create profits, and where the shareholders are willing to share those profits with, where the entrepreneurs are sharing it with shareholders, and if the shareholders are disciplined to have a 10-year, 15-year horizon, they will make money. And that we have seen in last 30 years. There are enough business models in India, some of the banks, some of the monoline auto companies, some of the specialty chemical companies, pharma companies, who have created immense wealth. So, this is something interesting point I'll highlight. For many good stocks, which are, which you must be observing every day in your life, when you buy some medicines or when you buy a consumer item or you use a credit card of a bank, just look at their absolute returns over the last 20, 30 years. If these companies have been around for long, these numbers are 15,000%, 20,000%, 25,000%. But we read these numbers in IRRs as 12%, 14%. So 12 and 14 doesn't seem very attractive. But when you let it compound and see the absolute value of it, Berkshire Hathaway, we keep talking about it, right? Warren Buffett. I think 55 lakh % is the return he's made over some 65 years. And what does he say? That people take wrong lessons only from me, or half lessons from me. They take lessons like buy good businesses, add good valuation. That's great. Wo lena chahiye. But the most important lesson is that I've been investing for 60 years, 70 years. The lesson of time is something that no one is willing to take. So I think the biggest mistake we make is we think investing is a short-term game. It is a T20 or it is a 100-meter race. Investing is nothing but a marathon. Anything in the short term is random. You may make money, you may lose money. But if you just build a portfolio and give time to it, you will compound. You will see wealth growing up. The last point I'll say is that asset classes are volatile. So if you have a single asset class portfolio, it will have to go through sharp volatility of its own character. Equity has standard deviation of 16 units, which means every year, in the worst year, it has fallen 50%. Gold in the worst year has fallen 40%. Silver in the worst year has fallen 60%. So there will be years, once in 10 years, where you will go through such periods of fluctuation. Be aware of it upfront. If you can embrace it, build that portfolio and live through it. If you cannot embrace it, and most of us will not be able to embrace it, because who wants to lose money? And that's where you have to mix asset classes. So, our visiting card, I'll share it with you later on. It shows 4 asset classes: Indian stocks, global stocks, gold, and bonds. Indian stocks over 30 years have earned 13%. Gold has earned 12%. Global stocks have done roughly around 9 or 10%. And bonds have done 7. So 7 is the lowest return, 13 is the highest return. Highest volatility is with gold. Second highest is with stocks in India and the world. And the safest is bonds. So safety will give you 7% return. If you're okay with that, continue with that. But if you want 12 to 13, you will have to take fluctuations. Now, when you mix these 4 asset classes in a certain ratio, the mixture gives you a 12% long-term return, but the volatility is 1/3 that of equity. So it brings down volatility, but still allows you at least 10 to 12% return as your first step. For many investors who can't digest volatility, that can be a compromise to make. It can be an intelligent compromise to make. And that's where the role of hybrid and multi-asset funds. And I have one very simple formula that when storytelling is at its peak, when narratives are high, when euphoria is very high, when last 5-year returns look very good. So like when last 5-year returns are 20%, whereas the long-term return is 12, 13%, it means mean reversion has to happen. In such periods, I choose to invest in hybrid funds. Because that's when you are moving down to second or third gear of driving. From the 5th gear, I will go down to the second or third gear.
So is this a good time to invest in hybrid funds?
I still feel that because valuations are still rich, hybrid funds would be sensible for medium-term time horizons, and for investors who can't bear fluctuations.
Volatility.
But for those, like again, there are many who say, yes, I don't care. I can digest, I can confront volatility. Market falls 20%, I'll buy more. I have cash flows coming every month. I'm a 10-year, 20-year investor. For them, equity is fine.
So what do you do when you identify a good stock and the stock falls about 20-30%? For example, the recent thing that's coming to my mind is, say, Keynes. A great company, great business, EMS, growing, etc., has gone from 600 to 7,000 in 3 years. But now it's fallen 40% because of these corporate governance issues. What do you do here?
So I'll avoid on any single company, but the framework that generally we follow, see, always in a mutual fund, it's a portfolio approach. So there are some stocks every year which are down 20-30%. Now, if your thesis is right and if the company is still solid and continues to grow, or you have this view that this company over the next 3 years, 5 years is going to grow its profits by 15% or double its profits, and now the stock is cheaper, you will buy more. Sometimes it may so happen that you thought this is a great company, it is in a great phase of growth, but something suddenly changed in the economic environment, and that likely growth has got damaged, has got impaired for the next few years.
But in this case, is corporate governance issues, is it a deal breaker when you pick stocks?
Again, each individual investor has their own ways of analyzing. So there are some investors who say that if because of corporate governance issues, stocks are down 50% and I'm getting them cheap, I'm willing to take that call. This is one way of life. Our way of life is if there's a corporate governance issue, first you get out. You don't, because you don't know how long, how deeper is it. Because governance issue means that there's something which is hidden. Now, you don't know the quantum of what is hidden. You don't know the gravity. You don't know the materiality of that.
And you don't know how long it would take to resolve.
And then you're playing in blind. And sometimes you get out and the stock runs up. Now, these are things which will happen in market. There's nothing wrong about it. See, it is not perfect science. Let me tell you, the best investors of the world, they typically get 55 to 60% of their calls right. It also means they get 40% of their calls wrong. The best investors of the world. It's just that when they get it wrong, they risk manage fast.
They know how to move on.
And they move on. And that's the way to, so accepting this is very important. Many investors, many times in any mutual funds portfolio, including ours, some stocks would be down. One would ask that, okay, why are these stocks down? But that's nature of the market.
So you said the things to avoid is don't chase trending stocks.
Don't chase things which
narratives.
are beyond and which have made your asset classes up far above fair value. Now, this is not easy for an investor to know fair value kya hai. पहले तो स्टॉक का फेयर वैल्यू क्या है, फिर एग्रीगेट सेक्टर का क्या है, देन फॉर द होल फंड क्या है. These are very difficult things to do, and which is why I go back to the simpler hack that I gave. As an investor, I will see if the asset class's long-term potential returns are 12%, for example, and currently for the last 5-10 years it has given 20%. Incrementally, don't chase that asset class, or tone down or dial down your exposure to that asset class and allocate to something else. So on the other hand, let's say 2 years back, if the long-term returns of gold was 12%, and it is 12%, the near term, the last 1 year, 3 year, 5 year return of gold was 6 or 7%. So it was earning below its capacity. So ultimately mean reversion would happen. Which day onwards it will happen, you don't know. Let's say I had invested in one of our, aggressive gold strategy 4 years back. In the first year, it fell 20%. In the second year, it fell another 8%. And after that, it went up 200%. So net, I'm fine now. But the first 18 months, I looked like a fool. I felt that. So you'll have to be okay with that. See, the idea is not to try to win every day. The idea is to win the long-term marathon.
So you said in your first 10 years of investing, you made a lot of mistakes. Yes. What were they?
Exactly what I said not to do. So I used to invest and move every 3 months. So I was in a mutual fund. So I had my mobile app, so you could press few buttons and keep shifting. And in a mutual fund, there are always 5-10 products. When you have 10 products, one fund will do well and 9 will not do well relative to it, right? And in the next quarter, the second starts doing well. 6 months later, the 7th fund starts doing well. So, you feel that, okay, now this has started doing well, so my money should go here. So let me switch. And that switching from your lane into the lane where the car has just moved ahead. And then when you go there, you realize your lane only was good. So avoid doing that. Number one, avoid churn. Once you invest, have at least a 5-year horizon. Otherwise, don't invest. That was the first biggest mistake I stopped making. The second mistake was, in those periods, you would remember 2006, 7, 8 were eras where very weak companies had gone up 3, 4, 500%. Companies had no business model. Governance was not in place. So at that point, I used to invest in stocks also. Now I don't do that. But buying stocks without knowing what is that business about, buying stocks without even asking that, is it making enough return on capital to cover for the debt cost? Fixed interest rates in India, let's say 8%. So there were many companies who don't even do 8% ROE. But the stock may have gone up sharply because of, again, storytelling, narrative, blindly buying into them. And some of these stocks are down 80, 90% since then. And they never recovered because they were never worthy of investing in the first place. So these are periods. See, we are in a glorious period of last 10 years. And so many people, thanks to digitization, have
Entered the market.
And digitization, while it has revolutionized rightly, gratefully, thankfully, access and simplicity of investing, they've also made us swipe fast. It's like that Tinder world. You keep swiping left, right. So if you do that with investing, returns will not come to us. In investing, we need to be slow. We don't have to keep taking fast decisions. And like I said, you look at some of these global companies which have a 50-year track record. India mein 50 saal ka stock market track record nahi. That's why I'm saying US companies. The absolute return of the stock, even if it is a 15% compounding over 50 years, is some 50,000%. So I keep asking myself, I started in 98, so I have completed 27 years of my investing. The matter of pride for me will be how long can I be an investor? The length of my investing will be my matter of pride, not 1 year ka 12% or 20%. And I think it is the length which is the most important point. And I'll tell you why I say this mathematically. In the formula of compounding, we all know that it ends with raised to the power of t. So t has the most exponential mathematical sign. T has exponent next to it. Return के आगे सिर्फ plus sign है. So plus is weaker than exponent. And that is the message I want to give. That time is the hero in this journey.
So you've been investing for 27 years now.
Yeah, thankfully, because I joined this industry. I started my career being in this industry. I started in 98 and 99 is when I joined the mutual fund industry. So day one pe you were taught these lessons. So how much more grateful can I be where I was taught investing and paid for that? I was paid every month ki seekho. And that over time, and then surrounded by great people around you, you learn the right techniques.
So, in your investing journey, it was largely equities only, or did you invest in others, like maybe bought a house when you were younger, real estate, a lot of that?
No, so when I was getting married in 2003 or 4, my dad said that till you don't buy a house, I'll not let you get married. So the loan leke I had a small home in a far-off suburb. After that, for almost 20 years, I have not bought real estate because I see, again, I apply maths. Real estate yields in Mumbai are 2%, rental yields. In Mumbai, real estate is the most expensive. Infrastructure is not the best. Still, you overpay. You pay more than many other parts of the world. So my logic was, through my mutual funds, if I can earn average of 12 to 15%. In old days, we were earning higher returns because markets were cheaper. When you invest in cheap markets, you earn higher returns. So why compromise at 2 and 3% rental yield? So I never bought a house till 2021 in the period of COVID. After COVID, markets had doubled. And that's when I realized that in COVID ke time pe, we used to do a lot of these Zoom calls. All calls were digital, right? Work from home. So I started seeing the walls of my home for the first time through my videos. Otherwise, at work, you don't notice these things. Then I realized that an
upgrade is needed.
An upgrade is needed, and it was a rented house. And then...
So what age were you when you bought a house?
4 years back, 46 or 47. And stocks had done very well. So markets were very expensive. So I thought I want to do some profit booking.
So till the age of 47, you didn't buy your own house?
So one small house, you keep that. That was again lying idle. But till 47, I didn't buy a home. I lived in good rented homes, which were very good homes in good localities, but at 2% yield. A debt fund was giving me 7-8% return every year. An equity fund was giving 15-16% over a period of time. So mathematically, it didn't make sense. But of course, there are different joys when you have your own home. You have your own space. So it is an emotional decision. It is not a mathematical decision. But each person has to take a call depending on what type of phase of life you are in. You want to build capital first, or you want emotional, safety first. It's a trade-off. There's no right or wrong. I'm not saying what I did is right or what I did was wrong. Because I was mathematically inclined looking at these data points, and I felt that buying a house in Ville Parla at that point in time with my limited capital was not easy for me. So I thought, let me accumulate capital first. And rented homes were available of my choice. We needed a Jain Mandir next to our home. वो भी था. Great society, छोटा garden था, closer to my son's school. All tick marks were there, except the maths. So here money was compounding. And here for now, like 7-8 years, prices had moved nowhere. And stocks continue to grow at 15% at least over a 6-7 year period. So that's how I did my investments.
Any major regrets that you have in your investment journey or in your life journey overall?
Thankfully, I've been very fortunate on all parameters. Good family, good education, good colleagues around me, great industry. I learned from everyone. How many people can become a CEO in a world of 700 crore people? So I have only gratitude. So I don't have any regrets. Thankfully, everything has been great. And the only regret is when COVID happened, stocks fell 40%. I moved only 10% or 15% from debt to equity. Because उस दिन नहीं पता था कि ये start है या end of correction है. Every sharp correction feels like it is the start of correction. So I followed all my behavioral principles. I followed all my discipline principles. That when stocks are down 40%, you have to go into equity. You can't theorize that time that what will happen. So I shifted 15-20%. But still another 20-30% remained out because I thought I'll wait for some more time. Of course.
That was your fear kicking in.
It was not fear. It was because see, in March, तो शुरुआत थी lockdowns की. Who knew whether they will last for 3 months or 3 years? Who knew whether vaccine will come or not come? So the alternate future directions were unknown. So it was also risk management that I don't want to be all in because, I don't know how long is this going to last. And I can't be fully in equity in a pandemic which I've never witnessed in my life. I only read about it, that it happened in 1918 once and how the world was so bad. But when you live through it, so you always want to keep some safe buffer. So I shouldn't call it regret. It was good risk management actually.
Risk management.
But no regrets, to be honest.
So what are the behavioral traits that one should have to be a successful investor? We were talking about one of them, which is frugality, right? So that's why I remembered. But what do you think are the top 3 or 4 behavioral traits one should have?
See, I think investing is about delayed gratification. And there is this experiment, I forget the word. It is about if you tell kids that, read one poetry today, I'll give you 2 chocolates tomorrow. If you don't read, I'll give you only 1. So kids who have that patience to, wait for tomorrow, generally it has been seen that they do well in life. So delaying a gratification is very important trait in investing because the benefits of this craft of investing are back-ended. The benefits are not known on day one. You go and buy a perfume, you can use it right now, and you can realize अच्छा है नहीं है, and generally they are time tested. Investing, whether they are good or bad, is generally known 3 years, 5 years, 10 years later. And in between, there are periods of doubt. Like this year is a period of doubt. So that's the reality of this game. So one is to, be long-term in delaying your gratification, which means not overspending on things that we don't need. Not getting excited that there is an Amazon sale of 40% where prices are first jacked up 40% and then and many times you don't need those things. I have seen my grandmother who lived for 97 years, and when she passed away, her entire life was one small suitcase. Her clothes were within that. Her 1 or 2 books were within that. She didn't have, and she was the most happiest person in life. Frugal life lived well. That's a lesson that I take then, that why should I keep chasing? So I have this habit of buying fountain pens. Now, 2 ke baad, the third fountain pen has no incremental utility, but you keep buying it just sometimes to show off to friends who also like fountain pens. So sometimes I think we spend money on what we don't need. And few people are blessed to have enough wealth that all these things matter. But most people, who have come from where I have come, or all of us have come as middle class people, the first few years of our life has to be about saving enough.
But is frugality and delayed gratification something that you learned through your childhood conditioning, or is it something that you cultivated over time?
No, I think, most of us, not just me. I come from an era where we were all, born in 1970s and 80s. we all know what was our per capita, what was the amount of money in our households. So it was not
Everyone
out,
was largely paycheck to paycheck living.
exactly.
Yeah.
So it was not out of habit cultivation. It was no choices, right? A choice ही कहाँ था?
But today the world is different.
Today the world is, but actually not so. Again, less than 1% people have wealth in the whole world. Less than 1%. Others show that they have wealth, but very few people have really, free cash flow. So I've seen my parents working for 12 hours, traveling in a train from Churchgate to Borivali, and after that walking home, not taking an auto because saving money. उतना था ही नहीं. So you have learned these things by observation. I won't even say it'll be a lie to say I have learned it. I had no choice. Most of us had no choice, and then it becomes habit. And then when you start investing and you start seeing returns coming, the mindset is that कितना पैसा लगा सकते हैं यहाँ पे. उसके लिए you have to save. And then it is also about your preferences or patterns of life. So what gives me joy is thankfully are things which don't need too much of money. To someone else, what gives joy could be things that need too much of money. So that is a blessing for me, that what gives me joy is relatively cheap. तो खर्चा नहीं होता है. And then see, when you also invest and you understand business models, so today, let's say if I have to buy a product, I know which brand this belongs to. So I jokingly tell my wife कि Louis Vuitton का बैग अगर तुमने देखा है, thankfully she also doesn't have that habit. It is a 70-80% profit margin business. So it means just for that label, you are paying for something which is worth 20 rupees. और 10 रुपीज यू आर पेइंग 100 रुपीज. वो 90 रुपीज तो उसके शेयर होल्डर को जाने वाला है. तो हमारे ग्लोबल फंड में डाल दो, उसमें वो स्टॉक भी है.
और उससे फिर 10 लुई विटॉन बैग्स खरीद सकते हैं.
नहीं, उसके बाद भी लुई विटॉन मत खरीदना, बिकॉज वो लेवल है. मतलब ये मेरा there be enough people who can troll me for saying these things that you don't
No,
know.
I'm with you. I'm
and
with
I'm
you.
not moralizing that buying a Louis Vuitton is bad. I'm not making that statement. I'm saying it's my preference that many brands charge for the brand premium, not for the utility. Many cars will charge for the brand logo, not because the engine is the best, not because safety is the best. So somewhere you realize that for my utility, how much is good enough, and I'll pay for that. And the rest, why will I pay for the shareholder to make money? I rather become the shareholder.
No, I agree with you, and I'm of the same mindset. But one narrative is that we are perhaps of this mindset because of our conditioning, right? But that was good in our parents' time when they didn't have money. Now, the dichotomy is that our mindset is one of frugality, but our wealth that we have built speaks a different picture. Like, you can afford all that and more. Like, I was doing a podcast with someone earlier, a big fund manager, and he said, till today, I cannot bring myself to buy a business class ticket. Although I can maybe take my entire family or business class, but I still can't, that mindset shift has not happened. So I think that
it happens to me. I go to Hong Kong.
That is a bit problematic, to be honest.
But, so it's a trade-off again, and these are personal choices to make. So you have to decide at what stage you want to dilute your comfort zone. So when I have to go to Hong Kong to meet my niece, I go thrice in a year. So initially I used to say I can't take business class because why should I take business class? Now I have done one compromise. One trip I'll take business class के पहले और एक class है, I forget what is it called.
Premium economy.
Premium economy. So one trip I'll do premium economy, and next one trip is economy. Once in a while I'll see. Now if I travel to UK or US, which are very long distance flights,
but you can afford business class.
So that's the mindset change I need to make. But it takes time. So from economy, premium economy, one step I've taken. Once in a while, business, one step I've taken. But it's not still very easy.
But why is it not easy?
If 50 years of habits, you can't change overnight. Or in your mind, you have to make this quick, snap. That today onwards, I'm very different. And let me now think differently. And it's also again a trade-off. Like premium economy, when I went last time, it was very comfortable. It was the first row. It was as comfortable. So I felt
largely it's about convenience only.
Exactly. So I think we need to spend where, it gives us joy ultimately. And you're right that many people today who say that we don't want to accumulate assets. We don't want to accumulate units. You are a mutual fund CEO. आपको unit accumulate करना होगा. हमें नहीं करना है, हमको life enjoy करना है. We want to experience life. We want to travel a lot more. We want to live life differently. We want to spend on our friends and family. That gives me joy. Great, nothing wrong with that. If you can afford it, you should do it. But if you cannot afford it, because the other guy who can afford it is doing it, and if you do it, it will hurt your future. So we have to first safeguard our future, our family's future, ring fence that, and then we can start taking these calls.
So in your 20s, if you had to do things differently, and for people who are in their 20s or early 30s watching right now, what do you think what would your advice be to them?
See, I think, like I gave you this data point, that Indian markets have really created value for, in fact, over 30 years, it is the best performing market in the world. Last 1 year, 2, 3 year, 5 year, maybe lesser, or last 10 years could be poorer than US. But over a 30-year period, it has created immense value for believers of investing and for those who have had patience. So the only input I'll give you, because this is what I was not, I was impatient, I was reckless, I was constantly churning and jumping. So two big mistakes I used to make is invest on past high returns and invest for small periods of time and constantly change asset classes. That friction, the tax paid, buying high, selling low would have created significant impact on my small portfolio that time. Thankfully, it was a small portfolio. Today, if I behave that badly, it will have significant impact. So to a young investor, I would say you have the best raw material on your side, which is time. Buffett has said many times that, do I trade my wealth with time today? I have very few years left, and someone at 20 has maybe 80 years left. And very likely, with the type of medical innovation happening, we might all live longer. But if we live longer, if our money does not last our lifespans, we will be struggling. So the only two things which you should be taking care of is good health, so that you can live a good life for long. And if you live for long, compounding will automatically happen. Don't interrupt it. Be patient with your money. So start early, save more, stay disciplined, and don't take poor investing decisions. Poor means two things: don't buy at high, crazy prices, and don't buy low quality, junk quality. Most people don't know what they are investing in. So avoid that mistake. Know what you are investing in. Ask questions. If you can't do it on your own, search for a good distributor, search for a good advisor, do your homework. Today, so much of information and insights are available thanks to the type of work you are doing. Learn and then take decisions. Don't be frivolous with your hard-earned money.
Okay, that's some very sane advice. I thought we'll talk a little bit about international investing, because you folks have an offshore fund from Gift City now.
We've just launched one for LRS.
Okay, tell me a little bit more about it. Like, why should I invest in international funds through the Gift City route?
So firstly, it's not necessary to do international investing, or it's not any different than Indian investing, because ultimately both are equity investing and both are doing the same thing, which is buying companies, valuing companies, and deciding at what price to buy, and then staying invested for long. So both at its core will give very similar long-term outcomes with similar intermittent volatility, individually done. The only reason why I personally have felt, and that's why we promote to our investors also, is there are enough periods when one market does well, one geography's market does well, and the other slows down. The decade till last year, India did exceedingly well, US did exceedingly well, and the decade prior to that, US had zero returns. China was the best performing market. So in every phase, companies from different countries tend to do better or worse. It's a function of that country's economic cycle, geopolitical situations, or it is also a function of the business models of these companies. So there are many business models which are today not available in India. Some of the business models like the Amazons of the world, or the Coupang is an Amazon equivalent in Korea, or Trip.com in China, or Tencent in China. These are business models where, life may shut down without them. They have created that type of presence in day-to-day lives by building or by designing business models which are very difficult to replicate. Their design, so their success comes from their design, not from luck or not from other external factors.
Can you tell me more? Any examples?
So take Amazon, for example. Today they supply thousands and thousands of SKUs to thousands of cities in the world. Can it be replicated? Can a global Amazon be created? Not easy. It'll take maybe 10 more years to do that.
But isn't that a story that is already played out? I
Absolutely.
noticed you have these stocks in your global fund.
Of course.
Amazon, Meta, Tencent are all stories well known, right?
So Amazon, of course, has played out because a lot of returns have been made. But there is still no other Amazon which has come for you to, move to something else. Or I'll give an example of, we have this company called Tencent, similar story with many more levers. People chat on WeChat, people do commerce on WeChat, like on Amazon. It's a very integral part of that ecosystem. And because of whatever political reasons, that market had cracked down after COVID, the stock was at 10 times or less than 10 times on valuations. So sometimes you get great businesses at reasonably cheap valuations. So what we look for is not about whether the company is global, whether it is an American company or a Chinese company or an Indian company. Is it a good company available at good valuations? If you get such conditions right, your odds of making superior returns goes up significantly, because the core is not China investing, Japan investing, US investing, India investing. The core is good businesses at good prices. I think that's something that investors should really narrow down to. Today, we have that opportunity to participate in different parts. So there are great banks in India. There are great asset management companies in India. There are great pharma companies in India, which are market leaders. There are a couple of auto companies in India, which sell the highest number of two-wheelers to the world. So there are certain companies, certain things where we are good at. Happily build that portfolio. But there are periods when they are very expensive. And at similar points in time, there were many companies in Europe or in US which were going through their down cycle. So if you're able to spot these type of businesses, so we have a couple of strategies. The most tax efficient and convenient way of global investing is through a mutual fund. And within that, personally, my favorite way of investing is a single fund which has choice of Indian and global stocks. Why, as an investor, should I keep jumping various funds? In a single fund, the fund manager will allocate between good India businesses and good global business. That is the first way to invest.
So you have that fund?
We have a fund. We have a fund called DSP Value Fund. That's one way.
But that has a limit, right?
As of now, the limits are still open. So if you want to do an SIP for the next 10 years, very happily we'll welcome you to do that. If you want to put a lot of big lump sum money, we may not be able to take, because the limits are still not very large.
So how is that different from investing through GIFT City?
So now I'll come to that. Now, at large, all mutual funds will struggle with limits, or are currently struggling, because those limits of $8 billion are almost 95% or 98% full. At the margin, some open limits are there for one or two funds that I mentioned. So if you want to not worry about when will these limits get over, what will happen after that, will the fund dilute the global component, those questions could be there in your mind. The Reserve Bank has this liberalized remittance scheme window through which Indian investors save for global expenses, either for future travel or future expenses of kids' education. So under LRS, almost $25 billion gets transferred outside. Investing is one component of that. And thanks to the GIFT City ecosystem that the government of India has very beautifully built over the last 10 years, today we can launch a fund on GIFT City which can invest globally. So we have launched a 100% dedicated fund on GIFT City for global investing. Now, this fund doesn't have a fund house level limit or industry level limit, but this fund has individual level limit. So you and I, every year annually per PAN number, can do $2,500 or $2.5 lakh. So roughly around 2 crore rupees per annum per person.
And what's the minimum investment?
So we have done a retail fund, which is a $5,000 minimum investment. We want more people to, get exposed to global investing in a more institutionalized way, versus, yourself going and again searching for stocks anywhere in the world and not taking the right decisions.
And how does the taxation work?
So here, the taxes are paid by the fund. Whatever returns you make after 5 years, 10 years are tax-free in your hands. At the fund level, the taxes are 12.5% if we hold stocks for more than 2 years. And on the dividends that we earn on some of these companies, it is 40%. So the dividend tax is high, which is a marginal, disparity from the Indian mutual fund taxation. But dividend incomes are anyways not very material in your entire gains. So if over a long-term stocks earn 12 to 14% return, dividend yields are only 2%. So on that, you'll pay 30% extra tax on that marginal 2%. So ignore that for a moment. But broadly, if on Indian equity mutual funds, you're paying 12.5% tax on long-term capital gains, here, the effective blended tax somewhere, if you be a long-term investor, will come somewhere close to 14 to 15% over a long period of time. So marginally higher tax, but you're able to complement and blend. Now, the beauty of blending this is, so some time back, I had mentioned that standard deviation for Indian markets is 16 units and standard deviation for global markets is 14 units. But when you blend the two, long-term return still remains the same of an equity asset class, but standard deviation comes down to 10.
What does that mean?
So it means the fluctuations of the NAV of a blended portfolio are lesser.
The volatility drops,
Yeah.
basically.
So, when global stocks do very well, our value fund underperforms. But when global stocks fall a lot, our value fund does well because the India component would have done well. Likewise, this year, when Indian stocks have not done well, the value fund had only 65% in Indian stocks. The balance 35 was in global stocks. They did better. So when individual component does badly, the combined portfolio does far better.
So when you invest through Gift City, the remittance is in dollars.
So from here, you convert your rupee, from your rupee account, you instruct your bank to convert it into dollars in our Gift City account. So the money will get transferred to our Gift City dollar account. From there, we will go and buy portfolio companies. So as of today, it's a very soft launch that we've done. We've raised around, I think, 80 crores or so. And the portfolio is only 55% invested. We are very gradually building the portfolio. But apart from Amazon and Tencent that you mentioned, there are more interesting names in the portfolio like Trip.com, Coupang, Nintendo, BYD, Berkshire Hathaway, Constellation Software. It's one of the finest tech company which keeps doing acquisitions. But each acquisition is ROE accretive. So it's a great example of capital allocation story over the last 40 years. Then we have Brookfield from Canada. We have RDN from Netherlands. We have Universal Music Group. We have Deckers, if you wear Hoka brand of shoe. So it is owned by Deckers. The stock is down 65% in the last 18 months because of tariff news and the US-China trade relationship. So the stock got hammered. Great businesses, but so you are able to capture good businesses of India in our India portfolios, but you're also able to capture good businesses of the world when they are going through a down cycle. Either their market cycle is bad, their flow cycle is poor, or the company's industry cycle is bad, and that is why good businesses when stocks are cheap. So today, most investors in India lament कि हमें इंडिया बहुत अच्छा लगता है, but सस्ता नहीं है. यहाँ पे आपको सस्ता कुछ माल मिल रहा है. So blending it is a great way to build more resilient long-term portfolios.
Okay. So why should I invest through the Gift City fund when I can invest in your regular value fund?
You can. So like I said, the regular value fund, maybe if I get the next 300-400 crores, my limits may get over.
The limit will get exhausted.
So then you have to rely on me that we will stop taking new money in that fund so that the ratio of 75-25 will remain intact. If you don't want to, take that call and also want to build 100% global portfolio. See, because all of us are almost 99-100% exposed to Indian stocks. So someone who wants to start incrementally adding global stocks, the Gift City is a very credible alternative.
So what should the asset allocation be towards these international funds? If you have 100 rupees, how much should be in domestic equities, how much international, how much gold?
See, like I said, you are fine with 100% Indian portfolios also. It won't necessarily change your outcomes dramatically over a 10, 20, 30-year period because broadly all equity markets over time converge to their long-term returns of 12%. And let me say that mostly equity markets over a very long period of time, last 50, 60-year history shows inflation plus another 4 to 6% extra return. So some countries have given 4% extra, some have given 5, some have given 6. Right now, US and India have given 6. We are the best performing countries right now. Next 10, 20 years, someone else may be the best performer. Who knows? So doing global allows you to, be relevant if something else becomes important. If India continues to do well, as it has done in the last 30 years, doing global investing may be a bit suboptimal. As we speak on any day, I come with this belief that I cannot forecast the future. I cannot give you a definitive answer that India only will do well or global only will do well. I have no definitive answer and hence I mix. But someone believes that no, I think India itself will do well. I can. So keep that context in mind before you hear my next answer. Now, asset allocation is always personal. Each of us can have unique asset allocation. There are enough people who have 0 in gold and there are many who have 20% in gold. So there's no right or wrong answer, to be honest. It's like saying, what should be my diet today? Your diet would be very different, mine is very different. Personally, in my portfolio, I think I have around 25% in global portfolios through my mutual funds and through the LRS bucket. So currently my portfolio would be 40% of Indian stocks, 25% global stocks. So it is 65% still in stocks. These 65% can fall 30-40% if there is a global meltdown once in 8-10 years. It happens. It will happen. It will not happen just because I fear it. हर 8 साल में एक बार होता है. So someday it will happen. So 2/3 of my portfolio is in growth assets between Indian and global stocks. 1/3 of my portfolio, of the balance 35, is in bonds and gold. Gold has done extremely well, so incrementally I will probably slow down my allocation to gold. So my approach of investing is not investing a lot more in what has earned a lot more in recent times.
Yeah, you were saying that.
Yeah, so
earlier.
that is my approach. Now, this is a anti-approach to the trend approach. Momentum as a factor also globally has done very well over 30 years. That what has done well, you keep topping up on that. Don't debate what is doing very well till it stops doing well. It can continue to do well for the next 10 years. Who knows? So, in investing, and you will probably next time not call me again, because I don't have definitive views about most of these things. The only definitive view I have is don't overpay irrationally for that asset class, and don't be a short-term investor. Broadly, ये दो चीज़ अगर ठीक कर लिया, I think I will be in the top 5% investors of the world from a return point of view, not from a capital point of view. So that is my approach.
No, I'll definitely call you again. But in this last segment, we have something called the viewer query segment, and we've got a lot of viewer queries. So I thought, let me just toss some of them to you. Isha writes to us. She says, thanks for the opportunity. Here's my question. If one has bulk capital, what should be the strategy to invest across assets like equity, debt, and gold? My thought was to do an STP to a multi-asset fund, given the fact that most assets are heated up. Is this a sensible approach?
You should call Isha next time, because she already knows the answer.
She's sorted.
She's sorted, and I'm doing the same right now. All the bulk capital that I have, if at all what I get bulk capital, is in a hybrid fund or multi-asset fund. So right now that's what I'm doing. I don't want to take sides with any single asset class right now, because all asset classes are fairly priced. Nothing is decisively cheap or attractive. Indian stocks are also fairly priced. Global stocks have also run up. Gold and silver have also done more than equity. Bonds interest rates are reasonably low. They are not very high right now. So basically, spread risk is the theme for me right now, rather than chase returns. So I would do the same thing.
Okay. I'm sure you get asked this a lot. If they practice value investing, why did they apply in some overvalued IPOs recently like Lenskart?
No comments on anything which is about a single stock.
Okay. There have been a lot of MNCs selling their Indian counterparts such as Whirlpool. With so much selling being absorbed and ownership, do these companies offer good opportunity with a 1 to 2 year time frame?
See, in equity, investing with 1 to 2 year time frame is like a toss of coin. Anytime 1 year you could lose 30% return or make 30%. So 1 to 2 years is anyways a wrong time horizon. And most of these MNCs are also selling because they are finding valuations to be much higher than what they believe should be fair value. And hence these companies could still go through some periods of time correction. And generally, I don't personally do single stock investing. So I am not an expert to guide on 1 or 2 or 3 stocks. I've always believed in a portfolio approach. A portfolio approach does not earn the highest return, but also does not earn the lowest return. A single stock approach or a 10 stock approach can give you highest returns if you are skilled and lucky, or it can give you the worst return if you are not skilled or you are unlucky. So mine is a middle of the path approach, portfolio of funds, where there will be some stocks which would have done very well. There will be some which would have not done well. So that is the approach that generally we ask most people to follow, because we don't have the wherewithal to understand company by company individually. And there's a lot of fluctuation. There's a lot of role of luck in these things.
Okay. Fair enough. Someone asked, with FPIs dumping 1.5 lakh crores year to date and the rupee at record lows, should long-term investors pause global funds or double down on SIPs for currency plus valuation mean reversion?
So there's a dichotomy in the question that the input metric is 1 year of dumping, 1 year of currency fall. The question also is about long-term investing. So both are not in sync with each other. For a long-term investor, in the last 20 years, if I have been a long-term investor for 28 years now, I have seen the currency being dumped every year, for example, right? Every year the currency is lower. So every year had I thought, ki ab currency all-time low pe aa gaya, what should I do now? I would have not compounded at 15-16% return. So I think long-term trend of currency depreciation is very natural in emerging market countries. In spite of that, if there is inherent profit growth in that market, you will make money. Having said that, we are in a phase where valuations are high, and which is what I've been saying for the last hour or so. This is a period to be diversified in Indian companies, global companies, little bit of bonds, little bit of gold. broad base. If you buy gold, you're getting currency depreciation benefit. If you're buying global companies, you're getting currency depreciation benefits. This is, see, for a long-term investor, it is never a good time to stop investing. And you have some or the other asset class to invest. What is the point of keeping money idle in a bank account at 4 or 5%?
Correct.
So stay invested in hybrid funds if worried about volatility. Otherwise, ignore the volatility.
Is 2026 a year when we will see a real correction in the market?
Could be, or could be time correction. I think what we are going through, what we are witnessing, even the last year, 25, we had 20% correction first. Then markets bounced back another 25%. So we are back to square one, and they've been sideways. So the first year of time correction, we have gone through 1 year and 3 months now. September 24 was the last peak. We are at the same price right now. Maybe it might continue for a year or so further.
Okay. If the world is moving towards de-dollarization, could Bitcoin become the most trusted global currency since no single nation controls it? So should one think of investing in Bitcoins from this POV, leaving aside all the other arguments?
I don't understand Bitcoin. I tried studying about it in 2015-16. It went all over my head. Who owns it? No one owns it. Then who owns it? Where can it get lost? What is the formula of its design? Can overnight governments come and do something about it because it becomes a challenging force to their hegemony? Who knows? I don't understand. Which was, as of today, I have nothing in Bitcoin. And over and above that, it's not regulated yet. So I anyways can't comment on it. Neither can I invest in it.
Okay, fair enough. What would your long-term target be on the Nifty for the next 5 years?
Never done it in last 30 years. I don't even remember aaj ka Nifty kya hai. It has helped me still earn my 15% CAGR, so I ignore these targets.
Are they allowed to invest NPS money in international? If yes, what is their exposure? Not
yet.
Okay, fine. Last question. They are both sets of funds, small cap and small cap 50 quality index funds. As a fund house, what do they believe? What will save investors and a better approach to invest in small caps?
See, we launched the quality index. We were the designers of this quality index along with NSE and Nifty, and we were the first to launch this. And our thesis was that typically, the small cap index is 250 companies. And history shows that more companies in the small cap index are generally fragile in terms of business models or volatile to economic shocks and business cycles. And having a quality filter at least eliminates weaker companies or weaker business models. So my bias would be to always think of quality. Having said that, in the last 10 years, any stock with high ROEs in the small and mid cap universe has run up very sharply on valuation. So if you want to invest in small cap quality index, do it through an SIP. Don't do a lump sum.
Okay, last question, and it's a bit controversial. If you don't want to answer, you don't have to. When will they find another Aditya Khemka and start a good healthcare fund for small investors?
Please read Chirag Dagli's investing approach. Look at his portfolio over the last 5 years. You will be happy with Chirag Dagli.
Okay. But do fund managers matter that much? Because, that's been my primary concern about active funds, that when I invest in an active fund, I go by the fund manager, 10 years later, the fund manager has vanished, then what to do?
See, do fund managers matter? Good fund managers matter, obviously. And not so good fund managers don't matter. Is it a worry that every few years fund managers may change? Yes, it is a natural phenomenon. Why can't they change? I have changed my jobs 4 times. You have changed. You have been more long-term, but you have also changed. I'm sure your viewers would be telling CNBC that why is this churn happening? So churn is going to be natural. And the industry has also matured now over 25 years. Many of the old guards will retire. Younger teams will take over. So it is a reality that fund managers do matter if you choose the right fund manager. If you have the knack of choosing the right fund manager. Most often you get to know the right fund manager after 10 years. Because only after 10, like I said before, this is a game of getting back-ended outcomes. The feedback loops are late. You get to know the goodness or the mediocreness of any talent much later in this business. And it's not about the fund manager, any one of us who are in this business. So isko samajhna thoda mushkil hai. It takes time. My portfolio largely still is with active funds. I know the team that I work with. I have hired most of them. I also feel that maybe I have the arrogance or belief that even if you have to hire new managers, we'll be able to attract the right talent as a platform. DSP has been around for 170 years. So we'll be able to get people. But it is not easy. And which is why we also, with all humility, tell investors that if you can't identify a fund manager in advance, if you can't choose him at the right time, if you can't be loyal to him when he's not doing well, a great fund manager also 3-4 years can go through underperformance. We've seen that with some of the iconic managers of India, and most of us give up on them at that time. And then when they do very well, the reversion of mean doesn't work for us. So another approach is to start with an index fund. At least meet the index first. In trying to beat the index, we don't even meet the index. So with all humility, we say both options are there. If you can understand how to choose a good fund manager, we upfront put out our investment frameworks on our website. We have very transparently written down what each fund manager thinks, how he thinks about growth, valuation, portfolio construction, risk management. Every year, our fund manager writes an annual letter on his strategy, on what were his mistakes, what could he have done better or worse. These are only with the intent of making you understand the fund manager better. We hope that our fund managers remain for very long periods of time. But it is a reality of life that things change. So I don't have a very easy answer to this.
But thank you so much for taking the time. It's been a long time now and I've taken up a lot of your time as well. But it was a great conversation. We've really learned a lot. So thank you for being with us on The Money Mindset.
Thank you for doing this podcast in your new version and wish you all the best.
Thank you so much. Thank you.